Video, let us look at the hammer pattern. So this is a daily time frame chart of GameStop company. This is a dollar chart. So this is a hammer. Okay, let's first try to understand what exactly is a hammer and what are the conditions that the candle needs to satisfy for it to be called as a hammer. So condition number one is it must come after a downtrend, because it's a bullish pattern, it's a bullish reversal pattern. Reversal doesn't mean that after this candle the price will go up. Reversal means that after this candle, the probability that the price will go down is very low, and the probability that the price will either go flat or upwards is high. So either of these two conditions can take place. Reversal doesn't mean that a perfect V will occur. So the first condition is it must come after a downtrend. The second condition is the height of the real body of the candle should be less than twice of the height of the lower shadow must be more than twice the height of the real body. So this lower shadow from here till here must be more than twice the height of the real body. That's the second condition, very important condition, because lower shadow represents bullishness. Then the color of the real body can be any color. It can be green or it can be red. Green means bullish, red means bearish. Or it can be white or black. White means bullish, black means bearish. The upper shadow, it at the smaller it is, the better. Okay, in this case there is no upper shadow, so which is very good. The real body of the candle, the smaller it is, the better, because it's logical, right? The smaller the real body, the more are the chances that the height of the lower shadow is more than twice the height of the real body. So these are the conditions to identify a hammer pattern. Learn about the nuances of that condition. One last thing, the low of the hammer becomes support. Okay, so that line can become support in the future. In this case, the hammer is not testing prior support, so this is the support. So this trade would be risky. So if you buy here, you are taking a risky trade because it is not yet confirming or testing the support. So for example, if it had tested like this and then went up, then it would have been a very high probability hammer. So let's see what happens after this hammer. So as you can see, the price goes up. So if you look at the entry exit points, so that would be your entry point, that would be your stop loss, and probably this would be your target, right? Or this one would be your target. Now it did not reach this target, but at least it achieved this target, and the reward to risk ratio was easily 2:1 on this trade, but it was a risky trade. Okay, please understand that. See, this target was achieved within how many days? This is a daily time frame chart. So 1 2 3 4 5 6 7 8, within a 2 weeks, less than 2 weeks the target was achieved, because 5 days is 1 week, so this is 8 candles, so less than 2 weeks, a week and a half, the target was achieved for a nice 2:1 reward to risk trade, in spite of the fact that it was a risky trade. So that's the hammer. Let me summarize the conditions for you. It must come after a downtrend. The height of the lower shadow must be more than twice the height of the real body. The real body should be as small as possible. The upper shadow should be as small as possible. The lower shadow should be as tall as possible. And the low of the hammer becomes support. So those are the basic conditions to keep in mind before you identify a hammer. Go to this link. I have a training program there where I discuss this pattern in detail.